Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently a lot of brothers and sisters have joined the community. They've been asking questions about investing in the stock market. Where do I start? What do I do? And my default answer has always been, look into ETFs because it's slightly, it's a bit safer than actually buying individual stocks. And the reason I say that is when you're buying ETF, you're buying 100 to 200, 300 different companies in one basket. You just find one ticker, you buy it, you leave it alone. Someone else does all the maintenance for you, and you just pay that bit of an expense ratio, which is quite expensive right now for us. But inshallah, hopefully in the next 5 to 10 years, the expense ratio will come down. And then I said to them, okay, if you've got time and you're still young, you want to learn about basically buying individual stocks, this is what I suggest, okay? And this is what we're going to focus on today, is basically this idea of looking the S&P 500. So this is basically the sectors within the S&P 500. There are 11 of them. When I first started, like I've always said to you guys, is I start looking at each individual sector and say, okay, what companies am I actually familiar with, and which ones are of the ones that I know are Sharia compliant, and which ones are the top 5, 10 within that sector. Then that's when I started doing my research. So what I'm doing now is I'm doing that for you. So I'm actually looking at we looked at healthcare recently. So that was the last video. We looked at the technology side of it. We looked at the industrial side of it. So we've done 3 so far. And in today's video, we're going to do the consumer staples sector. And the consumer staples is basically slightly different, okay? And before I get to that and explain what it is and so on, I would genuinely appreciate if you can join us in the Patreon account, where it will cost you about 15p per day, but you get basically the Discord access, where a lot of brothers and sisters are sharing good practices. They share what they're doing, what they're selling, what they're buying on each day. They talk about the news and things that are happening in the stock market. Also the buys and sells that I actually make, and also you got to the frequent family portfolio updates, which is basically once every 2 weeks I actually update the portfolio and actually explain what I've done and what I've changed and so on. And then you got the dividend trackers, and then you got the Sharia compliant investing ebook, which will help you inshallah if you are investing in the stock market for the first time. Now let's talk about the consumer staples. So consumer staples for me are really genuinely one of the most important sector within the S&P 500. The reason I said that is technology is great and so on, everyone talks about it, but consumer staples are some of those companies in there are very stable companies. They have been around for donkey years. They pay dividends. They are slow growers, but they're very reliable. If the stock market crashes today 10%, they go down about 2%, 3% maximum, because they have a very low beta. And every single portfolio should have, okay, this is not financial advice, but in my opinion, at least the 5-10% of these companies in their portfolio, in that portfolio. And the reason I said that is because I do have that more or less similar to that. At one point, I had more consumer staples while I was learning and while I was trying to understand. I understood technology, I understood consumer staples, because every time I go to the supermarket, if I walk in today in Asda, Tesco, whatever, okay, Walmart in the US, whatever, the stuff that was in there was the stuff that these companies sell. So I knew there was a tangible basically product to these companies sell that I normally buy. So let's get started and talk about these 5 companies in today's video. As always, of course, this is not financial advice, so please do your own research first. One of my favorite all-time companies within the consumer staples is Procter Gamble. This company sells every single product out there, including Head and Shoulders and so on, okay? 390 billion market cap. They have a wide economic moat. The moat, I always say to you guys, it is important because that shows us if a company has a wide economic moat, that means basically they have they're a bit more competitive there than their competitors. They have a moat around their business. No one else can come into that business, basically into the market, and take shares away from this company, or their sales will not go down because of that. So because they were very well known and so on, right? So currently they are trading $165 per share. They have a dividend yield of 2.4%, which is quite nice. Payout ratio is right now 57%. It's slightly higher than I would have liked. The latest increase was 7%, and the 5-year growth rate is basically 6%. Now, in terms of dividend streak, 67 years of increase in that dividend. So this one is a dividend king. Dividend king is a company that have increased the dividend for 50 year plus. So for 50 years, think about stuff that happened in the last 67 years. We have also the wars and also the madness, recessions and this and that. But guess what this company has done? They increased their dividend. And the reason is because they have a predictable free cash flow every year, and they give some of that money back to their shareholders. And this is what I really like about these type of businesses. Technology and all the high-flying companies, they are great, okay, but this is stable. This is like, you know what you're gonna get. Basically, they will pay you $4 for every share of this company you own. 99% safety. Now the highest you can get is 99, so that's what they've got right now. In terms of the revenue side of it, in the last 4 years they grew about 4%. Okay, last 5 years they be basically 4%, which is fine. That's what you expect. EPS about 7%. Again, that's what we expect. So that 4 to basically 10% is basically what we expect from revenue side of it for every single year for these companies, and EPS as well. Profit margin about 18%, return on equity 31%, and return on invested capital basically for 24%. And again, you get that stable, you know the company basic management are doing really well. The profitability side of the business is absolutely intact, and you've got that 16 billions of free cash flow that they can actually use to acquire other businesses, pay us as dividends, buy back their own shares, pay off any debt. So really stable. Total return the last 10 years about 9%. Growth estimate next year about 6.4%. The next basically 5 years they're expecting almost 8%, 16% premium right now. $143 per share is where they think the price should be. Now, looking at the EPS for this company, for the earnings, moving forward, we're looking at about 11% in this year, then 6%, then 7%, then 6%, and then so on for the next couple of years. And when it comes to revenue, we're looking about that 3%, 4%, like we've already said. So nothing absolutely huge to worry about when it comes to this company. Now, if we look at the ratings, where they basically analysts are saying right now, what the analysts are saying, about 11 strong buys, 5 buys, 7 holds, and 1 sell. And that's about 2-3% upside from where we are right now. And according to Morningstar, which I really like, it's about 16% premium. So I would definitely say, for me, that's basically what I would go for. $140 per share. I do own it, and I will share it with you guys at the end of the video, inshallah. Next one is Colgate. I'm sure you don't need me to tell you anything about this company, because you buy their product without even thinking about it. They have a market cap of $76 billion. Wide economic price right now is $94 per share. Dividend yield for 2.1%. Payout ratio 57. Again, latest increase of 4%. 5-year growth rate of 3%. And they have increased this dividend 61 years as well. So another dividend king. You get $2 for every share of this company that you own. 90% when it comes to safety side of things. 4% in terms of revenue growth, 4% when it comes to EPS. Again, that's what you expect from this type of business. Profit margin 13%, return equity 2,331%, return on invested capital of 42%. Free cash flow right now $3 billion, total return 5% in the last 10 years. Growth estimate next year 9%, then 8.4%, 14% premium right now. $82 per share is where they think the price should be. Now, if we go back here and have a look at Seeking Alpha and go to the earnings side of things, okay, first, if we go to estimates, as you can see, he's about 9% almost every single year for the next 3-4 years when it comes to EPS, and same thing again, 4% and so on when it comes to basically revenue side of things. And right now we got 10 strong buys, 5 buys, 6 holds, and 1 sell, and that is about 4% upside from where we are, which is interesting. Now, moving on to the next one is Kimberly-Clark. That is again another company that sells more or less similar product to Procter Gamble and Colgate. A lot of the nappies and so on. 45.5 billion market cap, narrow economic, but $138 per share. Dividend yield 3.5, which is really good. Payout ratio 69 right now. We don't like that, so it needs to come back down to at least 60 and below that 60. Latest increase was in 3%. The 5-year growth rate 3%. 51 years of increase in it. Again, another dividend king. $4.88 is basically what you will get for this company, every share of that company you own. Safety 80%, so we're not worried too much about that. The growth basically for the last 5 years when it comes to revenue is 2%, 3% of EPS, profit margin 9%, return on equity 209, return on invested capital 31%, $2.6 billion of free cash flow, total return the last 10 years in the 5%, growth estimate next year 6% after that for every year. Fairly value right now $143 per share is where they think the price should be. And looking at the basically in earnings expectation side of things, 8%, 6%, 5%, another 7%, and so on. Again, this year when it comes to revenue, they're expecting it to be flat. So year over year basically has not grown at all. And then 2%, 3%, 3% after that, just like what we said before. That's more or less what you expect from these companies. It seems a bit of hold at the moment. Three strong buys, strong buys, 3 buys, 11 holds and 1 sell and 1 strong sell, and that means it's about 3% upside from where we are right now. $143 per share, that's basically what they're expecting. 143 is basically what they're also expecting, so it's fairly valued according to Morningstar as well. Next one is Hershey. This is snack company. I do own this one in my portfolio, and currently basically has a 37.9 billion market cap, wide economic moat, $186 per share, dividend yield almost 3%. The late payout ratio is almost 50%, latest increase 15%, for the 5-year growth rate 10%, dividend streak of 14 years increase in that dividend. $5.48 is what you will get for this every share of this company that you own, the highest that we've seen so far in terms of payout. 80% when it comes to the basically the safety side of it, 5% in terms of the revenue growth in the last 5 years, 9% in terms of EPS, 18% profit margin, return on equity 54%, return on invested capital 28%, $1.3 billion of free cash flow, 8% in terms of total return in the last 10 years, 2% growth expected next year, then 2% after that every single year, 11% discounted right now, $210 per share is where they think the price should be. And looking at the expectation for this company moving forward, especially with EPS and revenue, this year is flat, so that's probably why it's down quite a bit. Next year is about 2%, then about 5 and 8.5%. A lot of this is happening because of the prices of cocoa, for example, right now. So when that comes back down again, because it's gone up so much, when it comes back down again, their profit margins will start increasing. So we'll see what happens with that. In terms of the revenue side of it, 2.6, again 3%, 4%, again for almost 4%, 4%. So very similar to what we've seen with the other companies today. So let's have a look at what Wall Street is saying. 5 basis strong buys, 0 buys, 19 holds and 1 strong sell, and it's about 11% upside from where we are. $206 per share is where they think the price should be. And finally, we got Clorox, another company that benefited from COVID. This company went to the moon when COVID happened because everybody was basically cleaning and buying their product. 16.3 billion market cap. I'm sure it was triple that at that point. It has a wide economic moat, $131 per share, dividend yield over 3.6%, which is quite nice. Payout ratio 80%. This is absolutely ridiculous. They need to break that down. The latest increase was 2%. Growth estimate basically the 5-year growth rate was 6% and 46 years of increasing. So they are now a dividend aristocrat, which is a company that has paid the dividends and increased it for 25 years in a row. And so so another 4 years they will become a dividend king. $4.80 is what you get for every share. Safety 70%, so nothing to worry about. Despite being payout ratio of 80 right now, the safety is 70%. 61 and above is safe, which is fine. The 3% when it comes to revenue growth in the last 5 years. EPS about 2%, 3.3% when it comes to profit margin, 510% when it comes to return on equity, return on invested capital of 28%. Just over 500 million when it comes to free cash flow, which is low, but again, look at the market cap in comparison to some of these companies. So you have to, relative to the market cap, it's not actually that bad. Total return in the last 10 years, 6%. Growth estimate next year, 9%, then 12%, 23% discount right now. $170 per share is where they think the price should be. And finally, looking at the earnings estimation side of things, this year they're expecting the earnings to grow about 16%, which is nice, and then 9%, 6%, 7%, 9% after that. And looking at the revenue side of things, is actually declining about 3%, then bouncing back about 3%, then 3%, then 3% after that. So nothing huge to worry about, but again, is one of those companies that is slow growers if you think about it. Strong buy is 1, buy is 1, 15 holds, 2 sells and 2 strong sales. and right now it's about 14.5% upside from where we are. $150 per share is where they think the price should be. Now there you have it. That's the 5 companies I wanted to share with you guys. Like I said to you before, please do, as always, do your own research when it comes to Sharia compliance side of things. According to Zoya, Sharia compliant side of things, their standards are basically is there. Pause the video, have a look at that, inshallah. But like I said to you guys, if you are building your own portfolio, it's very important to diversify. Like basically what I showed you earlier, this is my actual portfolio right now, and as you can see that it's quite diversified, but I don't have any utilities to consumer communications, because there's not that many companies that are that Sharia compliant. Real estate, I'm getting rid of it, definitely. That 6% right now is the PSA, or public storage, and I'm going to get rid of that. Apart from basic real estate and possibly utilities, I can invest in the rest of them happily, and not to worry about any debts and all of those kind of things, or non-Sharia compliant. Even you will think financials, there's not a lot of companies that are halal in there, but of course the financials is a huge sector, and there are companies in there that are kind of data companies, or the indices and so on. So yeah, that is basically what I have been focusing on in the last whatever years, and I hope you're enjoying this type of content. If you are, please join us with the Patreon account. Like I said, it will cost you 15p per day, and you get a lot out of it, inshallah. Have a wonderful day. Assalamu Alaikum.